Hello and welcome to this module, The Auditors Are Coming. Today we'll be looking at what happens when the auditors come out to visit your organisation. Now if an audit visit makes you feel nervous, you're not alone, but audit plays an important role for any organisation, and what we will be looking at today is understanding what audit is for and how we can make the process less painful for everyone involved. So our objectives for today are to explain who auditors are, describe what they do and what they need from us, and also to identify ways to make their visit less painful. Right, let's start off by thinking about who the auditors actually are. There are many different types of auditors. Generally the ones you're likely to come across are either the internal auditors or external auditors. External auditors, as the name suggests, are those who are external to your organisation. They're usually from a firm of accountants such as Deloitte or Grant Thornton or any number of other firms which provide an audit service. Internal auditors are part of your own organisation, but independent from the day-to-day running of the business. Why do we need two different types of auditors? Well, they look at different things. But today, we're just going to focus on the external auditors. What do they do? Ultimately, your external auditors are going to give an opinion on your financial statements as to whether they are true and fair. There's no real definition as to what this means, but basically, it means are the numbers accurate and are they presented in a way that is not misleading? They give their opinion to the shareholders, the people who own the business but who are not involved in the running of it day to day. To do this, they need to come out and look at how those numbers are prepared. They can do this in two ways. They can look at the processes you have in place to prepare the financial statements and what controls you have. Controls are the activities you carry out to make sure things do not go wrong, for example, a bank reconciliation. Or they can test substantively, which means they check the end product of that process, the numbers themselves. This is sometimes referred to as ticking and bashing. In most cases, there will be some element of looking at controls and also some substantive testing, although sometimes the audit may all be done substantively. When the auditors are looking at controls, they're likely to come out before the financial year end and may interview you to understand the process and the controls. It's important to remember that when they're interviewing you, and in fact in all your interactions with the auditors, they're checking the process and the controls, not you as a person. They're only going to give an opinion on the numbers, not the people. And what do the auditors want from us? Well, first of all, they need something to audit. At the very least, at the start of their year-end visit, they're going to need a trial balance. Your auditors may have a list of information they need to start the audit. If they've not sent this to you or someone on your team, ask them for it in advance so you have time to prepare. Having the auditors sitting around doing nothing is not good for anyone. They also need access to you and your colleagues to ask questions. They can't do a very effective job if they're guessing at why the numbers are what they are. So make sure you've set time aside to talk to them if you're likely to be one of the people they need to speak to. It's also worth flagging to them what are good and bad times for you. Most auditors are happy to work around your schedule as long as they can talk to you at some point and do not have to wait for days. If someone comes to you and asks you for a certain report, it's worth asking what they're trying to do. They may just be asking for the same information that was on file last year, and you may have a better way to provide them with the information they need for testing. There are a couple of other things to bear in mind when it comes to the auditors. They use something called materiality when they look at the numbers. Contrary to popular opinion, the auditors are not going to look for every little mistake of £1. It would take far too long and would not be cost effective. If an error in the accounts is material, it will influence the reader of the accounts. If it's immaterial, it can be wrong without changing the view of the reader. Each audit firm will have their own guidelines on calculating materiality, but generally it will be based on revenue, profit or net assets, depending on the nature of the business. For example, for a retailer with revenue of £100 million, materiality is likely to be around £1 million. So they will only really look at the larger items, or ones that the readers of the accounts will focus on for other reasons, such as director's pay. Have a look at these statements. Which do you think is correct? The auditors will ignore anything under £1 million. They'll test everything over £1 million. They'll focus on balances over £1 million and look at the others on a sample basis, or that the audit fee will be £1 million. The answer is C. They'll focus on balances and transactions above this level and look at others on a sample basis only. It might seem a bit odd when the auditors ask to look at all debtors over £100,000, plus a whole bunch of small ones, but their approach is based on statistics and means that if there is a mistake, there's a pretty good chance they'll find it. It's worth pointing out here that this approach means they will not necessarily spot fraud, particularly if it's small, but that's okay, as it's not really their job to spot fraud. although if they do spot it, they do have to report it. And one last thing the auditors will be looking for: a room they can work in, and access to tea facilities. You can make them uncomfortable, but it won't make them leave any quicker. It just leads to grumpy auditors. So that's a bit about what auditors do. How can we make life easier for everyone while they're here? Audits can be made less painful with some simple preparation from both sides. Know when they're coming out, what they'll be doing, and the information they need. It also helps if you understand their deadlines, such as when their audit partner will be reviewing their work. Do the auditors understand your business? They don't work for it, so they won't understand it as well as you do, but you can ask to have the same auditors as last year, so they can hit the ground running. And you can arrange to give them a briefing, either verbally or written, so they can know a bit more about it in advance. As with anything, communication is key, so keep communication channels open. The sooner you know the issues they've identified, the sooner they can be addressed. Many issues are actually just due to miscommunication or a lack of information, so make them go away before the final meeting. Make yourself or a point person available throughout the audit and ask for written updates. Via email is usually sufficient. This allows you to check their understanding of your explanations and has the added benefit of providing evidence of your cooperation if and when the audit partner comes knocking for overrun costs. Some auditors can be quite junior and young, and they might come across as scared or at the other end of the spectrum arrogant. It's not ideal, but it happens, so try not to let it bother you. A couple of years in audit and they won't be feeling quite so confident, as it's a very steep learning curve. So a quick recap of what we've covered. Remember, auditors give opinions on numbers and process, not on people. They work to materiality rather than to every little pound, and good communication and planning can make the process easier. So you should now be able to explain who the auditors are, describe what they do and what they need from us, and have identified ways to make their visit less painful. Goodbye for now, and good luck with your audit.